Hi, everybody. This is Robert Chadwick with America Mortgages. Thank you for joining us for this latest webinar. This is a very exciting webinar, and it's often requested dealing with U.S. taxes. Thomas, if you could join us on camera, that would be fantastic, and I'll introduce you. Today, we have one of our preferred partners, which is Thomas Carden of American Tax Advisors. Thomas is not only a CPA, but also a tax attorney. And much like us, where we only focus on providing U.S. mortgages for foreign nationals and expats, that is his job as well when it comes to U.S. taxes. So Thomas, with that, if you could introduce yourself and your company and what we'll do, or the process of the webinar is you can go through your slides, explain the process. I will go through after that, and we will talk about U.S. mortgages and the process of getting a U.S. mortgage as a foreign national or an expat. And then for everybody listening and joining the webinar, we will have a question and answer. So as we go, if you have questions, you can drop it into the question and answer box. And also, as a reminder, in the chat box, there is a link to set up an appointment or arrange an appointment with either a loan officer with America Mortgages, and this is 24/7 schedule, or to be able to speak with Thomas or one of his team members. So Thomas, thank you for joining. I really appreciate it as always. Perhaps give us a brief about you and your company, and then we can start the slides.
Again, my name is Thomas Carden. I'm the Director of American National Tax Advisors. I think we're one of Southeast Asia's largest U.S. tax-specific firm. We work primarily with U.S. expats and foreign nationals who have investments back in the United States. So whether you're a U.S. citizen who has rental properties in the United States, or you're a non-U.S. citizen or resident alien, you can still buy property there. The laws are the exact same for you. There's no discrimination. And we help handle from tax strategies all the way up to tax planning and the actual tax returns as well. So we're a full service shop dedicated to helping people deal with U.S. tax issues.
Fantastic. So let me get your slides. Apologies.
While you're doing that, Robert, I'll give a little bit of an example of wealth that can be built up in real estate using the tax advantages.
Absolutely.
𝐉𝐨𝐬𝐧 passed away the last couple of years. He became fabulously successful buying rental real estate. Started off many decades ago with one small apartment building that he converted into university dorm rooms. In 2007, he sold his corporate rental real estate, mostly office towers, for $39 billion US. At that time, it was the largest leverage buyout by the Blackstone Group in history to this. And he started off by buying one property, using that to leverage to buy more properties, and continuing to grow and continuing to grow and continuing to grow. One of the biggest, most successful track records of building wealth in history has been through U.S. rental real estate. And a lot of people think that the tax advantages aren't there, but the rental real estate is exactly the exact opposite. It's meant to build housing, so there's a lot of tax advantages and tax credits you get for doing this. And we'll go through and discuss that in detail.
Yeah,
this is a fabulous way to build wealth.
I think you're absolutely right. And I think the U.S. specifically has a very bad rep when it comes to taxes. But when it comes to this type of taxes and working with experts like yourself, it is the exact opposite, especially if you look at global investment.
Yeah. And we'll go through all the tips.
With that, let me start the slides and we'll go from there.
This is my title, my firm. Our website is aitaxadvisors.com. And we can go ahead and move to the next slide. Okay, through this, we're going to go through several different parts of this. U.S. taxation and rental income, taking advantage of deductible expenses, depreciation, and then at the end, we'll give you a little more detail about who we are and how we can help you, and give you a consultation if you need one. Okay, non-resident aliens. Now, because this is an international presentation, I'm going to feature a fair amount of information on non-resident aliens to this, but there's a lot of these things do pertain to U.S. citizens as well. Okay, as a general rule, a non-U.S. person who rents out his or her home is subject to a 30% withholding tax imposed on the gross amount of each rental payment. Okay, but, and this is a large but, the foreign owner earning rental income can easily have the 30% withholding obligation removed. The foreign owner must only pay tax on net rental income on the U.S. tax return. And that's a very, very important part, because You're going to get a lot of credits and advantages that should very rarely actually show net positive tax on a US tax return. Next slide. Okay. Now, there are a myriad of different things you can take off as a deduction off that gross rental income. So that 30% tax is not based upon your gross rent, it's based upon your net rent. Okay. Property management fees are going to be the big one, especially if you're owning, when you're living overseas outside the United States, you're going to have a property management company. Those fees are 100% deductible. Advertising and marketing. Should you choose to run ads in the local paper or Facebook that you're paying for, advertising and marketing are absolutely free. And that includes using a service that will do the advertising and marketing for you as well. Leasing commissions, should you pay a real estate agent or anyone else for a commission for getting a lease? Totally deductible. Repairs and maintenance. This is a big one. So, anything you're repairing. So the doorknob breaks, that's the thing. If a door needs cracks or something, if a facade needs to be repainted because of a scratch or any type of thing like that, totally percent covered. The pipes break, you've got that as a deductible expense. Utilities. Now, some landlords pay the utilities. Some landlords have the tenant pay the utilities, but the landlord is paying the utilities. Again, it's a deduction off of that gross rent, thus reducing that 30% down and down and down. Property taxes. So you're going to pay, when any local jurisdiction in the United States, you're going to pay some type of property tax. Those are deductible. And then insurance. Obviously, you're going to have insurance on the property. Those fees each and every year are a nice deduction for you. Next one. Okay, mortgage interest. This gets to be really, really important down the line on this. Okay, your mortgage interest on a rental property is 100% deductible against the income on that rental property. Now, using that later on as a strategy becomes very, very important, because by refinancing your mortgage at a later date, you can take out cash out of your rental property and have no taxation on that adjusted loan to this. We'll go back to that later on. Legal and professional fees. Even your tax prep that's devoted to that rental unit is deductible. License and permits. Should you choose to go build a pool or put a fence up where you need a permit and a license, those are deductible. Homeowner association dues, deductible. Capital improvements and depreciation. Okay. Now this is going to be really important here, because depreciation varies heavily from a repair. Okay. Depreciation is any structure that has a lifespan generally more than a year to this. So, and it would generally be an improvement. So if you have a base piece of land, the first thing you would depreciate is, if you put a house on it, you would depreciate the house over 30 years. Okay. And that means 1/30 of that house gets used as a deduction each and every year off your tax return. So if you buy if you build a $300,000 house, you get a $10,000 expense each year against your rental income on that property that comes to it. Now, should you go in at some point and you buy an existing property and you put a new roof on, a new roof will have an extended lifespan because it's not a repair. This is a new roof on the property. You would be able to depreciate that roof off over so many years. Should you put in a new washer and dryer, you're going to have about 5 years to expense that thing out. What this does is depreciation and the mortgage interest allow you to be cash flow positive, but tax flow negative. And that's a real key to this. Because of all these types of expenses to this, and the depreciation is kind of paid up front money and expense, you get the expense over the period of time. By using depreciation, you can be, again, cash flow positive, but tax flow negative to this. Now, here's a big one for people owning property in the United States. Your travel to inspect the property is a deduction against that rental property. So should you choose to go in and see that property once a year to inspect it, it is a deduction off of that gross income through this, with this. There's also some stuff called pass-through deductions, where other types of expenses can be passed through as well to you. Okay, we're going to go through the depreciation here. Okay, in real estate terms, rental property depreciation is a basic accounting principle that effectively allows you to deduct the cost of a large asset with a useful life of 1 year or more over a longer period. In effect, rental depreciation, thanks to phantom expenses, can help provide tax advantages by offering you means to move into a lower tax bracket to do away completely with any income tax bills you might face. Now, remember that 30% tax you had on the end of it. We've already taken all the other expenses away with this, and including the mortgage interest off this. But when you factor in that you have 1/30th of the house being deducted each year, you're probably going to break even from a tax standpoint to even potentially lose money. Now, here's the other thing: if you are a U.S. citizen, you're able to take a loss on your rental income in excess to this of a passive advantage. So you can take $25,000 a year against your regular income and your salary, as long as you're below certain minimums. It's about $125,000 a year before that phase out begins. But you can actually take your $125,000 income and move that down to $100,000. So not only do you save tax off the rental income when you're cash flow positive, guess what? Your salary gets less taxed with this as well. So that's one of the biggest advantages, and why lots and lots of Americans who are middle income earners own rental properties, because they greatly reduce their tax on their salary as well. It's one of the biggest reasons why to own one or two rental properties if you're a U.S. citizen in the United States. Let's go to the next slide. We'll go through a couple more items on this stuff too with this. So rental property gives you so many different advantages on what you can do with this. It's tremendous. And what 𝐀𝐦𝐬𝐧 was doing was, and this is the real strategy to this, 𝐀𝐦𝐬𝐧 bought one apartment building. He was able to go in and he converted it to dorm rooms, and he started renting it out. And oddly he figured out the chic ideal time for college students was a very simple, almost like a loft style. So he put that into his first building, and he starts becoming cash flow positive on this property. And guess what? After a few years, he builds equity in that property. Now, that equity is very, very important, because you can do two things with that equity. You can choose to pull that equity out and take cash out to this. In fact, generally, after about 5 to 7 years, you've got the property in a high enough increase, because of generally an 8 to a 10% increase. You could pull all your original money out in the value of that you put in that property. But guess what? You still own the investment. It allows you to do that. But if you don't want or need that cash at that particular time, you're able to use that equity as a down payment towards the next property by refinancing and using more leverage. Robert can probably explain that a little better to you later on by doing this. But it allows you to start building those properties one by one based upon your initial investment. Now, and here's the wacky thing about rental real estate from a purpose of this. You really don't want the rent to break more, be cash flow positive to you, especially in the first 5 to 6 years. And let me explain the math on this. Okay. If you buy one property for $250,000 and you have no mortgage and you're making an 8% yield, it's going to be less than $25,000 a year of income to you. Okay. And that could potentially be cash flow positive or tax flow positive because you have no mortgage interest. However, let's say you go and you buy 4 rental properties for $1 million with your $250,000. Okay. You now have $1 million of property. So prior to that, the first property where you've only bought one at $250,000, you might get an 8 to a 10% appreciation each year. But when you use leverage and you buy 4 properties and you're getting an 8 to a 10% increase each year in the value of the property, suddenly you're making $100,000 a year instead of slightly less than $24,000 to $25,000. So if you look at real estate as a long-term growth in this, and you let the debt be covered by the rental real estate, you are tax flow very, very tax flow negative, cash flow positive, but you are building wealth at an incredible rate with this. Where else are you going to get an investment? You put in $250,000 and get $100,000 a year growth in. It's really rental real estate with it. You know, there's a whole lot of options on this. Now, one of the things we do each year is for American Mortgages clients, if you contact us through email, and the last slide has our contact details on this, we'll give you a free half-hour consultation to talk about your specific tax issues. It's about a $300 value for you, and we can go through your specific tax issues that'll help you cover this, you know, in a real way to this. And we can also go through, there's already a great one on setting up an LLC. We can help you do estate planning on this. We can help you minimize those taxes. depending upon how you set up and where you're from. You can also even look at tax treaties and get even more efficiency on your home country, depending upon the country you live in. There's a lot of tax advantages in these processes that will help you out and save you some money and help you grow your wealth. And that's the whole idea. Use this to grow your wealth.
Thank you, Thomas. Super interesting as always. I know the slide was actually quite short, but I'm assuming, like we have with other webinars with you, we'll have a lot of questions.
Yeah.
I think the questions are already starting to build in the chat. But just to, I guess, discuss what you were just talking about. So the depreciation that you can take to offset the income, whether you're a U.S. citizen or a foreign national, how does that work specifically?
Well, one of the second rules of real estate is, well, the first rule of rental real estate is buy rental real estate. The second rule is never sell rental real estate. Okay. And the United States have some interesting things about this because if effectively the idea in the U.S. tax code is that house, the building structure itself, will go to a zero value over, say, 30 years. Okay, so if you put a $300,000 house, the tax code effectively says that the value at the end of 30 years will be zero. So each and every year on that $300,000 house, you'll get a $10,000 deductible expense against that house. Now, we all know that that house in 30 years from now is probably going to be worth more money because the replacement cost of labor and all those kinds of things and the materials go up and up and up. But the tax code does not do that in any real way. So it gives you an expense off that property. Now, this is the reason why you never actually want to sell rental real estate, because when you do sell, you would have to recapture that depreciation off of the rental property. But what you don't do is you never sell. What you do is you would go back to American mortgages, you'd get a new mortgage, pull your cash out, still own the rental property and allow it to grow. Now, should for some reason, maybe the neighborhood deteriorates, the house is becoming too much maintenance, you can do what's called a like-kind exchange and move from one rental real estate property to another rental real estate property and have no tax consequences on moving from one to another. You can also buy a more expensive property with the new mortgage to this and continue your mortgage that way with it. So as long as you never sell a rental real estate property or you just exchange from one to another, you get very, very large tax advantages. And like I said, you can buy more more rental properties over a period of time. You can take your cash out should you choose. I'm over leveraged now. I have too many rental real estate properties that don't want to buy anymore. You allow them to become cash flow positive, and you can begin to pull your money out just by your refinancing mortgages on a regular basis. And this has been a strategy that has worked over the decades. Google 𝐉𝐨 story, and you can really see how this works very, very well. It's a way to build tremendous wealth.
I also think that, and correct me if I'm wrong, or anybody can correct me in the chat, but besides the fact the U.S. has no stamp duties, the ability to minimize or even sometimes even mitigate capital gains tax, which is certainly something that everybody has to deal with in the U.S., whether they're foreign national or expat, can be done with effective tax planning, either through a 1031 exchange, like you just explained, or even carrying any tax loss forward and deducting it off of the.
It's the code is meant to be, if used properly, is meant to be in a way that's set up to be beneficial to landlords, and they're very, very landlord friendly. Now, some states will vary depending on their individual policies of tenants and stuff, but from a federal government standpoint, it's very, very friendly. They want landlords to be able to increase the supply of houses in the United States. There's still a critical shortage, as both you and I know, Robert, of housing in the United States. So the tax code has always been very, very friendly to providing more housing supply. And the way to do that is to make the tax code friendly. If you tax something less, you're going to get more of it with it. And that's why these codes are set up and structured in such a way that you can pull money in, you can pull money out when you need to, you can put money in, you can buy more rental units, and you can begin to build your structure over this. The 54 now, and I wish I'd bought 3 rental properties when I was about 24, because it would probably be 50 rental properties now by just constantly rolling these things over to this over and over and over again. And the rental yields right now, they vary between your areas to this, but around 8% rental yields, you can cover your mortgage, you can cover all the expenses, you can cover the insurance, all those things with this. And then that property will grow at about to an 8 to 10% over year by historical track records. Now, again, you put $50,000 into a house and get a mortgage on that house, your rental yield is not based, the yield on that increase in the property is not based on your $50,000. It's based upon the $250,000 you put into it. A 10% yield, if you get a good yield going on that growth of that, the sale of the property house value, you're making $25,000 a year in net worth increase. You're not going to find that anywhere else with it. The rent should cover the debt service and expenses. Let the value of the property work for you.
Yeah. Now, I think especially as we talk to a lot of clients that may not, are curious about buying a U.S. property and obtaining a mortgage. But a lot of this has to do with educating them on the fact that taxes in the U.S. are actually very favorable when it comes to owning investment properties. So I'll go through my slides now, and then as we go forward, we can talk a little bit more about the taxes and questions and answers and so forth.
Sure.
So hopefully I can share my screen properly this time. Okay, so again, thank you everybody for joining. We will go over what we can do when it comes to U.S. mortgage providing for foreign nationals and expats. Again, 100% of our clients are living and working abroad, but obtaining a U.S. mortgage, whether it is for a purchase or for a refinance or cash out. So the general overview, no U.S. credit is required. We prefer if you have a credit report from your home country. However, we do realize that there are some countries that do not have credit reporting agencies, and we can actually work around this. But if you are, say, in Canada, for example, and you have a credit reporting agency, or even in Europe or wherever it may be, if you can provide your current credit report, then we will use that in lieu of U.S. credit. No AUM is required. As we do a lot of work with private banks, the issue with private banks is they obviously don't want to lose AUM. So all of our loans are what's considered dry funding, meaning that you do not need to open up a bank account with any type of bank that's going to be providing the mortgage. We allow for foreign earned income. Doesn't matter what currency, it's all accepted, just as if you were earning your income in US dollars. Loan programs in all 50 states, which is absolutely fantastic, really opens your options. If you're a foreign national, you can get up to 75% loan to value on a purchase, 70% on a refi. And if you're a US expat, we try to make it exactly like you're living and working in the US and walking into a bank, and you can get 80% on this type of properties. Normally, once you submit your paperwork, and we have a very slick platform that we just launched that allows you to take the application online and upload all the documents securely. Once we have that, it takes us approximately, I would say 72 hours, often sooner, to be able to issue you a loan approval and a pre-approval letter. Once you have that pre-approval letter, then you can actually go shopping, because if you do not have this letter, most realtors or sellers of the properties will not accept your offer. So it's very important before you do anything that you actually get pre-approved for a loan. On average, closing times are 30 to 45 days, which is fairly quick. That is for a standard conventional mortgage. We do have loan programs in the event that, say, you need liquidity very quickly, that we can close in a week. You can sign your closing documents in most countries, so there is no need to travel to the US, and there's a variety of ways to close your documents, from online signings to visiting the embassy to even signing at a local notary if the country that you're in is part of the Hague Convention. They can just get an apostille stamp. We have 30-year mortgages regardless of the borrower's age. I know this is a very unique thing to the US. And it actually is another reason why US real estate investing is by far the best market absolutely in the world. I don't care if you're 19 or 99. In the US, you cannot discriminate against anything, marriage status, sex, whatever it may be. And age is one of them as well. So the US allows that if you're 19 or 99, you should still have the same mortgage options. So age restrictions do not matter. A 30-year amortization, and we even have 40-year amortizations, will allow you to be able to maximize your yield by stretching the loan out over the longest period of time. We even have a 10-year interest-only program. This is absolutely fantastic because what it does is it allows you to pay only the interest for a 10-year period, but at a fixed rate. And after that 10-year period, you would expect that rate to readjust to whatever the prevailing rates are. However, it stays at the same rate that you fixed 10 years ago, but now you're just paying principal and interest. So you have a total of a 40-year tenure. If you're looking to maximize yield, this is the loan I would suggest every single time. We do common sense underwriting. And what does that mean? Well, if you were going to buy an apartment building, you surely would not qualify on your personal income. And your personal income obviously has nothing to do with the rental income. And this is how we look at investment properties. So in most cases, you're going to qualify on the cash flow of the property and not your personal income. If you're self-employed or maybe don't show what your true income serviceability is of debt, this is a perfect loan because as long as the property cash flows, the loan qualifies. And I'll go into that in a little bit more detail. We are super proud that 97% of our loan applications are approved. And this is because our loan officers, and I truly believe this, are the best. They are all over the world. They focus only on providing US mortgages for foreign nationals and expats. This is all we do. There is literally nobody that does this any better. And not only are you not having to stay up, say at 3 a.m. to talk to somebody in New York about your mortgage, you are working on your time, and the loan officer or whoever is dealing with you on our side will actually be the one staying up at 3 a.m. to deal with this. So it's a really simple, easy way to do the process. So I'll go through the loan programs really quick, and then we'll do our question and answer. So this is by far our most popular loan program, and this is what we discussed. This is called the AM Rental Coverage Plus. What this means is you do not need to provide your personal income. You're going to qualify on the subject property's rental income. We have loan amounts on these loans or in these programs as low as 100,000 US and all the way up to 3 million. Again, 30-year fix and interest only, regardless of age. And if you look at how you qualify for these loans, below it shows an example. So when we get the appraisal or the valuation report, we will also request one for the rental. And that is the amount that you will use to qualify. So in this example, if the rent is $2,400 and the mortgage, which includes the principal, taxes, and interest, is $2,400, the loan qualifies. It's a dollar for dollar. In the event, say the rent is coming in short, it does not mean that the loan does not qualify. It just merely means that you may have to put a little bit more than 25% down. So either way, and this is sort of how we get this 97% approval rate, either way, we can normally get your loan over the line. And again, 30 to 45-day closings, no US credit or residency required. So AM Student Plus, if any of you have children that are attending university in the US, such as myself, you realize that normally the first year they have to live in the dorm. After that, of course, they can live outside of campus. And as Thomas had explained, purchasing these properties around campus is absolutely a fantastic way to be able to not only have constant rent, but to be able to even maximize what you would be able to get maybe further away from campus. So in this particular case, the student is the tenant of the property, and that's how we look at it. So again, this is another loan where it does not qualify on your personal income, but it qualifies off of the projected rental income of the property. And if your child is 18, and say they intend to stay in the US, and we can add them to the loan, it is absolutely a fantastic way for them to start to build their US credit. And as you know, if you are intending on living in the US and doing anything, having credit is paramount. It's absolutely important. And this is a good way to put your child straight in the right direction. On this loan program, there is a minimum loan of $150,000, and we can go up to $3 million. And again, it's a very similar example to the rental coverage loan that we looked at earlier. The 𝐴𝐻 Investor Plus. Okay, this is actually a hybrid of a loan program. So as an example, perhaps you start out with doing the rental coverage loan. So on this particular loan, say you don't qualify or the property doesn't qualify on cash flow, you can actually qualify using your income. But because we're doing loans for clients all over the world, certainly it'd be very difficult to go through everybody's tax returns. So what we do is we use an income letter. If you're employed, we want a letter from your employer with on the letterhead stating 2 years of income and current year to date. If you're self-employed, the same thing, but it's from your accountant. And we have a template for this, which makes it very easy to follow. So you will qualify on that as the income rather than providing your tax returns. Again, loan amounts on this particular program is $150,000 and up, but we can still do up to 75% financing. If you look at the example below, it shows how you would have to qualify. We go off of your gross personal income, not after taxes, before taxes. And we need to get at least to a 43% debt to income ratio, which I'm sure everybody, if they are real estate investors, do understand that in their home country. This is a very similar way to do this. If you are a US expat, again, as I said earlier, we try to make this loan program as if you were living and working in the US and you just walked into your local bank. We have the exact same rates as you would be able to get. You need to provide 2 years of your US tax returns. There is no requirement to have a W-2. So if you work for a foreign company that does not issue a W-2, that is no problem as long as you're still filing taxes. We want you to have at least a 680 credit score in order to really get the best opportunities with these programs. And again, loan amounts as low as $150,000. This also qualifies on a 43% debt to income ratio. So we go off of your gross income on your tax returns. And as long as we are looking at a debt of the housing and whatever debt may be for credit cards or so forth, as long as that is below 43%, the loan should qualify. If you are a high net worth individual, and when we started this company, our initial business model was working with private banks. So these programs were super effective and actually quite easy for high net worth individuals to qualify for. As you know, if you're high net worth or you're working with high net worth individuals, they can have very complex and very complicated tax returns, multiple jurisdictions, structures, etc. With this loan program, they can actually qualify on their liquid assets. And this would be cash in the bank, stocks, bonds, even crypto. What we would do is we would take a 2-month average of those accounts. We would divide it by the fixed period of the loan. and that would be the income to qualify. So if you look at the slide below, it gives you a very simple explanation of it. So in this account, if somebody has a portfolio of, say, of $5 million, we would divide it over a 5-year period, and that would be the fixed portion of the loan, but the amortized portion would actually be 30 years, but the rate would be fixed for 5 years. But that would give us an average income of $83,000. And as long as that mortgage payment is below that $83,000, the loan would qualify. The best part about this loan program is there is no encumbrance on the portfolio that you use to qualify. So if you use, say, a stock portfolio or bonds, and you used it to qualify, the day after the loan closes, you can trade it, you can sell it, you can do whatever you want. Fantastic program for high net worth individuals. So we have offices basically around the world, but our main office, obviously is in the US, and we're in the Asia banking capital of the world, Singapore, which I think gives us a lot of advantages and opportunities. So with that, I will open this up to questions with Thomas and I. So Thomas, what I will do is I will read the question, and then if it is based for you,
I got to give the legal clarification that I'm only talking to these in generalities. I'm not your tax advisor until you hire us, so I can answer general questions. But if you've got a very specific question about your tax situation, you need to come hire us and discuss it. But we'll discuss generalities now and give you guys as much help as we can.
Yeah, absolutely. I think most of the questions, as we seem to always have, is this acceptable?
Oh yeah. That's why there's a little bit of legal clarification, because sometimes people will take something, because I just don't have enough information about your personal situation to give you full legal advice at this particular moment. If you do need that, give us a call and we're glad to help you out.
Sounds good. And with that said, in the chat, there is a link to set something up with either American Mortgages or with Thomas and his team at American Tax Advisors.
Yeah.
American International Tax Advisors.
Yep.
Okay, so first question, will there be a recording? Absolutely. Just like all of our webinars, it probably takes a week to come out of post-production, but it will be emailed to everybody that has either signed up and attended, or even if you have not attended. It will also be available, and we have a lot of webinars available on our YouTube. If you have any questions regarding almost anything U.S. real estate related, and even an old interview with Thomas, that's all available on our YouTube at America Mortgages. Next question, this would be for you, Thomas. Do you charge an hourly rate on tax consultations?
Yes, we can either do a half hour or a full hour. Generally, our rate is $4.50 for a full hour. However, if you email us, chris@aitaxadvisors.com, my practice manager, you get a free half-hour consultation just because of our relationship with American Mortgages. So that should give you all the incentive in the world to give us a call with it, because it's a $225 value that we give you because you're coming in through American Mortgages as a referral.
That's fantastic. Thank you for that, Thomas. And so I think everybody, if they do, I highly recommend Thomas and his services. I think everybody that we have referred to you has been more than pleased, Next question, is this assuming the property is owned by individual as compared through an LLC? Very good question. So last week, we actually had a webinar from a company that sets up LLCs, and you can actually even go to our website and you can set up an LLC through our website using this partner. But in general, you should be able to purchase a property in an LLC. And if people are not familiar with an LLC, and maybe Thomas, you can cover a bit of this as well, but it's just a fantastic way to not only maybe optimize some sort of tax advantages, but to be able to mitigate any liabilities that you may have within the property. So for us, we are an actual mortgage bank. We require you to do the transaction with an LLC. But if you do not, there are options. And Thomas, I don't know if you want to kind of just briefly talk about an LLC, but yeah.
I mean, LLC literally stands for Limited Liability Company. Okay, and one of the biggest advantages of it is exactly that. It limits your liability. Now, people for various flavors and depending upon your situation, some people will do this as a C corporation. Some people will do this as an S corporation, a limited liability corporation. And there are a myriad of different flavors and tax strategies depending upon how you do this. If you just want to own one property, the cost may not be there. But if you're planning on building an empire of this over a period of years, a company structure is generally better and more cost efficient for you. And that's really where on your specific situations, come talk to us. We can give you the flavors that you want to go through this and strategies of how you approach this. But generally, a limited liability company is generally the best with this. And that limited liability company doesn't have to be U.S. owned. It can be owned from another company overseas. In fact, here's a little bit of a trick for you. If you are not a U.S. citizen or tax resident, you set up a foreign company, say in Singapore, that owns a U.S. company. Now, when you want to go sell your properties out, if you can find another investor who wants to buy the Singapore company, they're buying that shares in that Singapore company. And guess what? You've never sold the property in the US. You don't have any US tax liability. You're selling it based upon whatever tax rates are in Singapore because you're selling a Singapore investment company with this globally. That's a way to begin to minimize your tax globally and handle this. Also, when you're coming into different company structures, you don't have any estate tax issues because that's not tied to an individual. It can be tied to a company with an unlimited lifespan. It's a way to minimize the potential estate tax on these properties as well.
Fantastic advice. Thanks, Thomas. Next question. Are there any specific states that offer more favorable tax conditions for non-US citizen investors? Very good question.
Well, this is one of the great things about the US. Okay. Even the state levels, it's non-discriminatory. So as a non-US citizen going in and buying rental property, you are treated the same as a guy who lives in California, Texas, or Nevada to this. There's no difference on how you're treated tax-wise in this. Now, if you're overseas, you may not be aware that the states have their own tax codes, and there's 50 of them to this. So you have two different layers of tax. You have federal tax and you have state tax. Now, several states like Washington State, Texas, and Florida have no state tax whatsoever. Highly like buying rental property in Texas, very landlord friendly as well. But you just don't have any income tax that you have to deal with in Texas as well. So when you're looking at rental properties, just go state by state by state. I can tell you that one of the least landlord friendly states is California, and also one of the highest tax states as well to this. But when you're looking at that, state by state, you should look at which is the most tax friendly for you through this. It's a very, very big part of this because it can change your yield dramatically.
Thank you. Next question. How do I manage taxes if I own multiple US properties?
The biggest issue of this is you need to segregate the expenses in your accounting system by property. Okay, so when you're doing this books, if you're hiring a plumber and you have say 5 houses, you would segregate that expense off to one particular rental property with this. And that way that Schedule E, where all this gets reported on, tracks to that particular house. So it's literally each house sort of becomes its own little business entity from an accounting standpoint, and that's reported through your tax structure with it. And you can sit there, and generally when we do, because we do, 1040 non-resident returns with rental properties, we do a bunch of them. Okay. And one of the advantages of that is we'll sit there and walk you through this. And when we're preparing your tax return, generally we're going to sit there and give you tax tips as well and say, hey, you want to do this, you want to refinance, you want to plan and strategize. And that process tends to happen about each year you're doing a tax return with this. And so as you move forward each year, you get a little bit of tax tips when you're preparing your tax returns. That's one of the things a high quality tax firm will do for you, is help you manage that on that yearly process as you're doing your tax return.
Thank you, Thomas. Next question. As a foreigner using an LLC, will we have to first do tax returns for the US LLC and then pay US taxes, if any taxes, under a double taxation treaty deal with our native country tax system? In quotes, Australia. Is this correct?
Yes, you have to do the US tax return in the calendar year after the rent is received. Okay. That will be the exact same with it. Now, because we've got so many different nationalities here, There are different tax treaties that will give advantages on particular things. It may say that any rental income can only be taxed at 5% or 10% or 7% in the United States, and then the remainder is taxed in your home country. Each tax treaty is different than that. However, that's generally on your net income you receive with this. You generally in rental property never want to receive net taxable income with this. It always calculates out to a negative, should calculate out to a negative number. By using depreciation and financing and leverage, you're able to minimize that tax flow in the US. So with proper planning, you shouldn't have any tax at all.
Fantastic. Nobody likes to pay taxes.
Amen. Amen.
Next question. You mentioned LLC. If it was a Wyoming LLC is set up to buy a property in a different state, say Texas, what are the tax implications in each state? Are there required filings in both states? I actually
Yes.
have the answer to this.
Yes, yes. Although you're in two states that's fairly minimal with it, and that's one of the advantages of picking tax advantage states with LLC situations. You're going to be fairly minimal in each of those two states, and that and that will vary wildly based upon all the states you're in with it. Because again, personal income is not taxable in some states, and other states it is. You're going to have to go by a state basis on that. But with the two states you talked about, you're about as minimal reporting as you're going to get.
And from my understanding, and again, correct me if I'm wrong, you're only paying tax in the state where you're earning the income, not where the LLC is registered.
Generally, yes. Generally, yes. Yeah. That can vary by LLC state by state, but you generally want to go Nevada, Wyoming or Delaware and minimize that reporting when you set up the LLCs.
Perfect. Next question. Is New York City, Manhattan condos the worst kind of investment in terms of value and cost? Hence looking elsewhere in the US. Which US bank should I open with a B1, B2 visa? Any suggestions? I plan to visit Arizona after New York in August. Let me touch on this a little bit because it's a little bit of a New York is a pet peeve for me. But maybe you have some suggestions as well. I think unless you're looking to buy a trophy asset, New York is not a good, well, Manhattan anyway is not a good place because I just don't see a good rental yield. Taxes are very high. And there's even though we say the US has no stamp duties, in Manhattan, there's a mortgage recording tax, which if I'm not mistaken is 1.5%. And then there's a mansion tax, which also California has, which is 1%. So you're basically paying a 2.5% stamp duty on a probably overpriced property that you're not going to get much yield on, maybe capital appreciation. I don't know. Thomas, maybe you can kind of expand on this a bit more.
And I would add California into this mix
Certainly.
as well. And both of these states are very heavily bureaucratic. They are very, very aggressive at going after any dollar they can get in potential tax revenue with it. And, overly bureaucratic and not landlord friendly at all to this. You get a bad tenant in these states and you can just YouTube bad tenant stories, and they'll tend to be in California, New York, because their laws are very, very friendly towards tenants who don't have to pay anything with this, and squatting laws and all sorts of issues with this. There are places and states that are growing traditionally in the south of the United States, and that includes places like Nevada, Las Vegas. Texas, again, is very friendly. Georgia, South Carolina. South Carolina right now is booming. I've truthfully been online looking at rental properties around York, South Carolina, because there's a lot of manufacturing moving into that area. If you look at where the trends of where manufacturing and the people who will need these kinds of jobs are going, that's into the South and into the Southwest. Look at those trends, because New York, it's got a long way to go before it clears up its landlord issues. And California is the same way.
I absolutely agree. And I think has a lot to do with the fact that people are moving out of these states and moving into more business-friendly states. Next question. How many months of salary statements or pay slips do you need on average? Well, this actually works out quite well for you. If you're a US expat and you're qualifying off your US taxes, then we'll need to see 2 months of your salary statements. But if you are a foreign national or say a US citizen and you want to qualify only on the rental income of the property, that is not required at all. We're not going to ask for any personal income. You're just going to qualify on the rental income of the property. Next question. Should I preserve my Hong Kong-based income, i.e. salary, for example, not necessarily equities, assets, or cash assets? I think the question is basically saying, should I buy equities or keep cash in maybe a high yield account, or should I buy real estate? And I think we both know the answer to this, but
Yeah, I mean, any type of portfolio should be varied across the board, with it. I mean, you should have stuff, multiple nations, especially more and more of a global situation to this. If Hong Kong tanks for some reason, the U.S. maybe strengthens to this. And generally the U.S., especially for immigration issues, should you have to go somewhere, if you're an investor in that country, and I'm not going to guarantee it's not an immigration advisor, but having invested in that country helps your status if you want to try to get into the United States. That's just a general concept. So if you do have several of these, you've lowered your risk for that. And again, one of the nice things about this is the way the yield works. Ideally, the rental payments cover the debt service, they cover the insurance, and so this thing comes out cash flow, slightly cash flow positive, but tax flow negative. But the valuation on that house increases on an annual basis by about 8 to 10% historically over a longer period of time with it. That's just almost set in stone. And if you look at areas that are growing, again, like Texas or South Carolina, you're going to have a lot of jobs moving in, and the property values in those states will generally increase at an even faster rate. So you're putting a $100,000 investment in, and say you buy a $500,000 house with this. Okay. That capital appreciation of that value of the house is at 8 to 10% isn't based upon your $100,000 investment. It's based upon the $500,000 value of the house. Guess what, guys? That's a $40,000 to a $50,000 net capital increase in your net worth each year based upon a $100,000 investment. You're not going to find that in a whole lot of other places. That's the strength of rental real estate.
I absolutely agree. And I think that's something that a lot of people don't think about, because especially if you're getting leverage and mortgage,
Yeah.
The yield that you're getting is the yield that you've borrowed the money on.
Exactly.
So you're certainly, if you've done this wisely and you have the proper tax advice and the proper mortgage, you're certainly going to see a significantly higher yield. And I think in general, having US dollar exposure in owning US real estate for that reason is quite good. It's still a fairly liquid asset, depending on what you want to sell it at.
Amen.
Yeah.
Amen.
Next question. I'm a freelance entrepreneur without regular income. Can I qualify for a mortgage? This is super common with us. We don't really, it doesn't matter to us if you're self-employed or you're employed, if you're qualifying off of the rental income of the property. Your personal cash flow is not a concern. It's the cash flow of the property that we want to see. So absolutely, there are no issues if you are self-employed and perhaps do not show what your true serviceability is. Next question. Are there any restrictions on the types of properties eligible for investment loans? No, in general. I mean, certainly some countries do have restrictions on certain types of assets that they can buy. I believe in Texas, farmland is not an option if you hold certain passports. But for us, when it comes to providing a mortgage, we can do everything from residential all the way to commercial, and size is not an issue. So certainly our own mortgage bank, we can only do up to $1.5 million. But if you have a property that's worth $100 million, we have done these transactions and we can facilitate. Next question. Can America Mortgages help connect foreign investors with local real estate agents? This is an excellent question. Much like partnering with Thomas's group and other groups similar, we also partner with realtors that we have worked with in the past or realtors that we have vetted. So if you get pre-approved for a loan and you're unsure of where to buy a property, you can talk to Thomas and discuss what has maybe the best tax advantages. And then once you figure out which state that you want, we can put you in touch with a realtor that we have worked with in the past that also understands working with foreign investors. And you may think that this is not a big deal, but it absolutely is a big deal because just coordinating time differences, et cetera, it can be a little bit of a challenge, but if we're working with the same partners all the time, it makes things just much, much easier. Next question.
Hold on,
Sorry,
Robert. One moment, Robert. You need to add in property managers as well. I know you guys work with some
absolutely.
very good property managers because at times you can have a realtor agency who is your property manager as well, but you can also hire separate property managers. And I know American Mortgage works with some very, very good property managers, especially when you're overseas. It's a very important thing. And Robert has worked with and found very good quality property managers because that's a very important skill. And it's part of the services that they offer. They can refer you to those guys.
Yeah, thank you, Thomas. And it's actually a free service too. We offer to anybody. We want to make sure that the entire process is as smooth as possible, not just from the mortgage prospect or perspective, but all the way through while you're owning the property. Next question. In AM Investor Plus, do you also consider rental income from the property as the AM Investor option? Wow, great. Yeah, that's a very good question. Yes, we can. So although you certainly should be able to carry the debt based on the income that you're providing in the letter, if it is potentially short, we can possibly look at whatever the rental income is being generated from that property as well. Next question. In the USA, do we pay you a fee? In our country, we don't. In fact, we get paid by the bank or by taking the business to them. So yeah, in the US, a mortgage broker is compensated by points. And if you think about the process behind this, it absolutely makes sense. Points or a percentage of the loan, which is normally 2% of the loan amount, not the property value. Because we work for you as the client and not work for the bank, we don't take any money from the banks. We charge the client the 2% one-time fee. But what that ensures is we're going to make sure that you have the best loan programs available, regardless of what bank it is. You go to one bank, they're going to only have that program. We have over 150 different lenders, besides the fact we're actually a direct mortgage bank ourselves. Next question. Can you take care both US and Canada cross-border taxation? Thomas.
Yes, we actually, that's really our specialty is cross-border taxation. We work everywhere we have Canadian clients, we have European clients, some in South America, Australia, New Zealand, a fair amount of clients. Our primary headquarters is located out of Bangkok. We tend to specialize everywhere from Saudi Arabia all the way up through Japan. But yeah, we have clients and deal with U.S. tax issues all over the world. Where actually there's an online magazine about expatriates that rated us one of the top 10 firms globally for doing this. And one of the things that we try to specialize in very specifically is mid-market clients. We'll do high net worth clients, but we try to help the average person out there handle their U.S. tax issues, whether that be a U.S. citizen living overseas or somebody with U.S. investments to this. So, we've got a team of 29 right now, and I have to add about 12 people to that in the next 12 months. That shows our kind of growth curve in this with it.
That's
so
fantastic.
We're a full service firm, and like I said, one of the advantages of this, because we've got a great relationship with American Mortgages, highly recommended you guys, Robert, every time. But because of the referrals in this situation, and if you've got questions, just give us a call. Mention American Mortgages. You got a free half-hour consultation, no charge whatsoever.
And again, the link is in the chat, so you can click on it and make an appointment while we're online. Next question. I meant today's tax talk is about LLCs or individuals. I'm sorry about the confusion on that. Thomas, I think you can kind of expand on that. This is both applying to individuals and to LLCs, correct?
Yeah, but both of these things work. I mean, the tax code in general in the United States is friendly, towards both businesses owning rental properties in the U.S. I mean, I think Blackstone and you're hearing more and more about these different private equity groups going in and commercially buying rental real estate in the United States, houses. And they're buying these things in mass at one point, although I think that's calmed down just a little bit recently. And the reason they're doing that is because the same type of tax benefits work towards businesses and large companies, investment companies, as well as towards individuals. I mean, when Sam Zell sold the company for $37 billion, he was using the same basic tax strategies that are available to individuals. It doesn't discriminate. Now, there are flavors of how this works in that in your tax planning. Depending upon where you are in the world, you may want to own this in a company overseas. You may want to own this in a US LLC. You may want to own this as an individual in times with this. And that's where part of that half-hour consultation, and even potentially more, when we can help you build a tax strategy that can help you with 400 rental units if you want to, or we can help you with one that, if you want to buy one rental property in the United States. There's varieties and structures on how you deal with all of that. And that's really where we get into the specifics of your particular tax situation. And more importantly, what your goals are with the rental property. To it.
Thank you, Thomas. Alistair, I see your question. Thank you very much. I look forward to your email. And it's great to see you again. Next question. No, I think it was a misunderstanding. Australia will just treat this as an investment in a foreign company, then either keep the money in the US LLC or bring back the income as a dividend. So the question is US LLC tax return first and then native tax return.
That's exactly how it will flow every time with it. The U.S. tax return will be done first. And it's possible, and again, I have to look at the tax treaty on the Australia, that sometimes rental real estate will have very specific tax rates that are available to it. But yes, the U.S. tax return would be done first, and then it would flow to Australia. And that's the basis of any type of bilateral tax treaty with it. We actually do have on our specialist, one of our specialists is a former PwC expat tax specialist who worked for several years in Sydney. So I have an Australian U.S. tax expert on hand, although he has left for the day because we're just about 6 p.m. here in Bangkok, but we can help you that. Give us a call and we can go through that specifically if you want to with it. No problem.
Fantastic. Gaz, thank you for the compliment, and we're glad that you were able to join and see some value in the webinar. Next question, what do you make of Miami as a place for investment? Well, I mean, I'll sort of touch on that, and then Thomas, you can expand, but I think we're both Florida fans.
Amen. I'm a Florida native.
Florida, oh, there you go. But I think anything in Florida is a great investment. I think Miami is a fantastic city, a very vibrant. And I mean, I think as long as you can get a good value in what you're buying, I think it's fantastic.
I'm from Florida, love Florida. There's a lot of flooding at this particular moment. God bless those people in Florida right now who are back there. One of the big issues right now, Florida is having a little bit of an insurance crisis just due to storms and the way the insurance system works in the U.S. being state-based. So it's actually, from a rental yields, it's fabulous. From a landlord standpoint, they're very, very pro landlord in this. But the insurance cost is a little bit high. What you're going to find anywhere you get closer to the water in the United States that can be possible hurricane, you're going to have some issues. Beachfront property, the prices are going up just because of base of insurance, of cost and ownership to it. Now, generally, the rents will cover that, but that's one of the more complex things about Florida right now. Specifically, property insurance on that's going to be a little stiffer. The more you go inland, say northern South Carolina, which sounds strange, north-south, but or Texas, Houston is a little bit there, but San Antonio, Austin is booming. You're going to have really great, and your insurance rates in Texas are going to be a fraction of what they are in Florida. Not that I'm bad mouthing my home state. I love it. I go back in a few months to visit my family there. So,
No, I tend to agree. I think you should always, especially when you're doing investments, look at the entire investment and
exactly.
So forth. Next question, it appears to be our last question, which thanks everybody. It says, what do you mean you are a mortgage bank yourself? Are you a lender or a mortgage broker yourself? So we are both. We are a direct lender in the US. So we have our own loan programs and we are underwriting and funding the transactions. However, we also do realize that we are dealing with sometimes very complex transactions or transactions that are beyond our ability to fund. And for that case, we are also a broker. So that allows us to do everything from residential to commercial transactions. So I think that's it. Thomas, again, thank you very much.
Thank you very much.
Appreciative. I don't know if you have any final.
I just actually want to say one thing and give you guys a compliment, American Mortgages. You know, I've been doing the expat tax business for a lot of years. And prior to you guys coming on stream and really focusing on this area, getting a mortgage when you were overseas on anything as an American citizen was just a minefield of paperwork. I would have to go to the embassy, get things certified that I signed on for the clients, provide millions of documents that seemingly made no sense whatsoever. And half the time they were being turned down with this. American Mortgages, if you're overseas, has done a great service to people who want to invest in the U.S. and rental property. Do not underestimate how valuable the service is that these guys are doing, to this. And when they called and started talking to me, a couple of years ago now, it was immediately how valuable that they were going to be for my clients. So, while they help refer a lot of clients to us, we also send a lot of clients to American Mortgages too. And truthfully, as I said, I've been looking at property in the rental property in the United States, and I'm obviously not going to go to anybody else than American Mortgages. It's a great, great service, and it will really help you build your wealth over time.
Thomas, thank you. Thank you very much. It's very, very kind of you to say. And again, it's the same as we feel, dealing with American International Tax Advisors as well. So with that, thank you everybody for joining. I really appreciate your time and Thomas's time as well. As always, we try to do these webinars at least twice a month. And if you have questions, you can go onto the chat and you can make an appointment with both Thomas or one of our loan officers. So again, thank you very much. We appreciate everybody. Appreciate your time. Thank you.
Thank you,
Thanks,
guys.
Thomas.